Future.
Welcome back. You're watching Money, 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 and this week we are discussing the storm in the fixed income markets and the kind of markdowns that investors have had to deal with considering the delay in payments by DHFL. Now, gentlemen, we've established that obviously credit risk is a phenomena that spreads well beyond credit risk funds. The question is now, what happens to current investors? Mr. Nath, your first thoughts, because as I read out some of these fund exposures, for instance, the Edelweiss Corporate Bond Fund had almost a 15-16% exposure to some of his DHFL debt. Then there is the Tata Corporate Bond Fund. Some of the UTI fixed income funds, they also have exposure.
In fact, what has happened, if you look at, is that 10%, 15%, in fact, some of the funds have 20-30% also, you know, and the primary reason for that has been the shrinkage of the AUM over the last 6-7 months, you know, and so they may have had 5 or 6% exposure to DHFL, but because the fund size itself has come down by 60-70%, you know, that 5% suddenly becomes 25% or 30%, you know.
So now what do I do if I'm an investor and I wake up and realize that my fund has taken a 75 to 100% haircut on some of these holdings? So obviously my NAV has been hit.
You just can't do anything, you know. In fact, but you should take heart from the fact that DHFL as an organization is a extremely, you know, well managed, or has been around for 2 or 3 decades or maybe more, has 1 lakh loans, home loans, so it's a retail book. So such kind of organizations cannot basically just vanish in thin air, okay? And therefore, sooner or later, the promoters will find a solution, which is probably will be lasting, and which will bring in the liquidity which is required to pay off these loans, you know. So I think people have to wait.
So no switch. I mean, don't think of immediately redeeming your money and redeeming.
You have to be be patient and find the promoters, because for let's say the promoters of the company, it is something a bolt from the blue, you know. They ran a company with a 1.5% delinquencies, you know, which is considered extremely good if you compare it with the PSU banks, which are 10%, 12% NPAs, you know.
And yet they're in the midst of this crisis. So obviously there's something that's gone wrong, or at least not right somewhere. But Kaustubh, again, the same question to you. What would you recommend? I mean, what should be done at this point? Should a switch be avoided? And also, some of the funds are now looking at this option of creating a side pocket, where you simply take out all the affected securities. So in this case, it's DHFL, and you put them in one basket on the side. And for instance, I think I saw Tata's talk about this. And then they're going to give equal units on the side pocket and the main fund itself. So how does the side pocket work, and what should one do?
Sure. So, you know, I completely, I'm with Raghvendra on this, that, you know, there's absolutely no point in panicking and selling out right now. You've seen huge markdowns in the NAVs. You take money off the table right now, you're booking those losses for good. And, you know, like Mr. Nath rightly mentioned, that there's enough and more. We spoke about it, that DHFL is taking all those measures to do. And, you know, it's a company that's got such a good, clean portfolio. You know, we don't see any reason why there should be, you know, sort of, I mean, it might take time. We spoke about that, you know, but, you know, you just got to be patient, and slowly but surely the NAVs will start coming back. And as and when, you know, if there's a bond maturing and DHFL makes the payment, you'll actually realize the full proceeds back if you're holding
you know, that actually brings me to a more immediate question. Now, for instance, the delay that happened where the 1150 crores was not paid, once this money comes in, which it has now, you know, come in, then what does that mean? I mean, the markdown can't suddenly be reversed, right? Right. So how does it play out, even though the money's coming now?
Yeah. So I'll actually break that up into 2. So funds that were due that money, you know, there are a bunch of funds that were due that money, and they receive the proceeds, the entire proceeds, they get the full value back, so that markdown kind of gets nullified.
Okay.
But funds that have longer dated bonds, you know, bonds that are maturing in 2020, 21 and beyond, the rating, the mark-to-market still exists because the rating has not been upgraded. And, you know, as far as we understand, it's not going to be a, you know, one swift rating upgrade, because, you know, if you just read the text around it, obviously, I mean, while they've done this, there's still some way to go before, you know, you can say that all clear. There is going to be liquidity pressure still on them, and that's going to continue. So even if there are rating upgrades, they'll be much more gradual, which means that the mark-to-market back up will be a lot more gradual rather than a swift 75% cut that happened. So that's something I think investors should be prepared for. But like I said, directionally, if you're headed in the right direction, you shouldn't really worry and try to get out of the fund right now.
Now, what about these side pockets? How do they function?
So, that's something that the regulator got in, at the end of last year, given that, we've seen some stress around it. And the whole focus is that, because, and we spoke about it, that some of these funds have had a huge shrinking of assets simply because, there were redemptions. They couldn't sell out of these the trouble bonds because obviously no one would touch them. So they had to sell the good quality assets, and that's why those sizes have ballooned. So what side pocket essentially lets you do is create a separate structure where you put the stressed asset into it. So at least the rest of the portfolio can continue to function as normal. So if there are redemptions or fresh purchases that need to be made, investors can continue to do that because that's part of the portfolio that's all clean, which is easily liquidable or you can add on to it.
But in terms of just to understand the NAV calculation, now if a side pocket is going to be created today in a fund which already took the markdown, so the NAV is already reflecting that drop, the side pocket would then not give me back my original NAV.
It won't. It'll give you the value of what minus that bond. So if DHFL is at 25%, it'll remove that 25%. That's my understanding, and it'll obviously value the rest of the bonds as they are. But that
so at least going forward, the overall fund will not suffer because of any of these issues.
The only risk in that, and I think that's the reason why funds are shying away. In fact, and this came about, I think, 6 or 7 months back, the side pocketing
SEBI
concept.
approval, I think, sometime in 2018.
But there's the first fund which has done it because the moment you take off that toxic exposure out, everybody will jump in and take away the rest of the money. So funds will actually end up with a lot of losses. But with the toxic exposure, I don't have a choice, but I have to stay on. But the moment the toxic exposure is taken out and put in a side pocket, the rest of the money I would like to take away immediately.
Even though it is at a loss?
Even though the other portfolio is clean, but my confidence as a retail investor is pretty low on the fund now. So I said, I'm getting my 75%, let me take it away. Let me see what happens to my 25.
Okay, that also brings me to the NCD holders. I mean, those who actually subscribe to the debentures, and I'm not talking about mutual fund investors right now. What are their options, Mr. Nath, if any at all?
Very little.
Okay.
I think because the thing is that if it's a secured NCD, they have a pari passu charge, which means that they are at par with all the other lenders, including banks and mutual funds. And if it's unsecured, in any case, they are subordinate to the senior guys. So they have very, very little options. Till that entire issue gets resolved completely, I don't think they have any option. I just hope that company like DHFL would very quickly find something, because for them, in the next 1 year, I think most of their debt will come up for renewals, because I think they have 40,000 which they have already paid, and they'll have another 20-30,000 crore coming in, So if they don't find a solution quickly, then it's
a wait and watch game. All right, we need to take a break on that note. On the other side, what are the important learnings from this event? And for those who still want to create a debt mutual fund portfolio, what are the kind of timelines you should keep in mind, and the do's and the don'ts? We'll be back in just a moment.